Hey Shara, thank you for those super hearts. Birthday super hearts. Thank you, thank you, thank you. Our goal for super hearts today is 23,000 super hearts. So thank you, thank you, thank you, thank you, thank you. You were on YouTube wondering where are the super hearts. Hey, yeah, you can watch on YouTube, you can watch on Periscope. We're live on both right now. Hey Hillary, thank you guys for tuning in. Welcome to A Moment in Time with Taylor. Please do click the link in the description, nextjuice.com/support, and help us to keep this channel going and growing together. First comment to the broadcast was Frankie on both platforms, Periscope and YouTube. That is impressive. Shara said this is her favorite sound, so let's give it to her one more time. Since she's making this channel possible, both with super hearts and also by going to that link. All of these people here have gone to that link over the last 30 days and helped to make this content possible, so thank you guys so much. I love and appreciate every single one of you from the bottom of my heart. And now we're going to finish our valuation of the Apple stock. So we started doing this the other day and I hit a road bump. So let me recap with what went wrong last time, because some of you guys actually, oh crap, what was his name? I'm sorry, I forget. There was someone, something Zaki on YouTube had specifically asked when I was going to go live. Frank or something had asked when I was going to finish this and show how the resolution of the problem that we hit in the last broadcast. I told him I was going to be in Florida this week, which is true, but I go tomorrow, and I thought, let me try to bang this out today for him, because I don't have a ton of people who follow me on YouTube, so I appreciate everyone who's showing interest over there, and I'm sure a lot of you guys that were watching are curious to see how I resolved that. So I haven't finished resolving it yet. I mean, it's resolved, but I haven't finished putting the numbers in, because I think that it's easier for you guys to learn how to do this by watching me do it step by step, rather than seeing a spreadsheet full of numbers and me try to explain it to you once the process is already done. If you can see what I do going back and forth between the reports and my spreadsheet, it'll make it a little bit easier to understand what we do. So the strategies that I use and the valuations that I use come from a book called Rule Number 1 Investing by Phil Town. Hey Shara, Shara's over on YouTube now too, and his daughter also has a book. Her name is Danielle Town, and her book is called Invested. I read Invested first, and then I read Rule Number 1. They're both great books. There's a lot of similarities between the two, as you can imagine, so it really helps to solidify a lot of these lessons. And I've already done a lot of the background on Apple and some of my previous broadcasts, so feel free to check out some of the replays. And what is more valuable, Apple or your Scope account? Definitely Apple. I mean, I've been going live on Periscope for almost 3 years, and Apple makes billions of dollars a year. Happy if I can get 60,000. So anyway. Thanks for thinking that I could possibly be valued the same as Apple. Now, what happened last time? I'm going to pull up my screen now so you can see what happened. Alright, so here's the page we're working from. I'm sorry for the low resolution on my video camera as well. I made it black and white so it's not quite as obvious. I'm traveling tomorrow, so this broadcast's a little bit kind of, pasted together. But all that really matters are these numbers and what I'm saying. So as long as you can hear me okay, I'm happy with it. Now, what had happened, so you can see where these two over here, accounts receivable and accounts payable, you can see how those are red. The depreciation and amortization was red as well, because I turned them red because I was confused, because I was not really sure why my numbers weren't matching up. So what had happened was I had pulled that over here too, so I'm gonna, sorry, let me try to spit this all out without doing it while I'm thinking. So that's what had, actually you just probably saw if I, let me undo that. So this says changes in accounts receivable on Yahoo, NASDAQ down. The NASDAQ is down, and I'll show you that, guys, right now. So if we go to look up Apple's cash flow statement on NASDAQ, this is what I always used to use. So if you've been following my broadcast for the past year on investing, you've probably been seeing, I actually do have some stocks through Robinhood. Yeah, hey DJ, thank you. So you can see right here, it says data is currently not available. And actually, if you look at this page, it looks completely different than the NASDAQ used to look. And I just saw this actually today up here. Oh, I don't know if you guys can see that. Can you see that on your screen? Yeah, you can see it. Where it says looking for additional market data. Wait, is that line in the way? Was that line always on there? I'm sorry, guys. Hang on. It's gone now, right? Yeah. The other line's on top of it too. Give me a second. Okay. Let me drop this. Sorry, I'm being a little anal right now. Okay. There. Now you can see. Looking for additional market data, visit oldnasdaq.com. So this was a very recent excuse me, a very recent change that they updated their website. Well, unfortunately, even if you click here, you get pretty much nothing useful. If you scroll down here, this has nothing to do with Apple, which is the stock we're trying to look up. So if you type it in here, Apple, it's very, very slow to load, if it loads at all. I don't even see it doing anything right now. Okay, here we go. And then you can see some information, but you're not seeing the income statement, balance sheet, and cash flow statements. So I was able to find that somewhere. This even looks different from what I was looking at earlier, I feel like. Let's see. Financials. Here, income statement. Oh, here we go. I swear, I should have streamed myself earlier as evidence, but earlier when I pulled this up, this was all blank. It had this down here on the side, and these numbers were blank. So this is what I used to use. Because of the problem we had just the other day trying to get all this information, and even problems I had earlier today and previously this week, I've decided to just stick to the guaranteed numbers, which are the actual SEC filings. So every year, let's take this off so you guys aren't getting too far away from me. Every year, any company that's publicly traded has to produce what's called a 10K report, an annual report that gives you all of the numbers that we need for our spreadsheets. Now, I feel like it's the way that you see it here on NASDAQ, where you have the income statement, the balance sheet, and the cash flow statement really easy to navigate between. It's sometimes easier than using the annual report, but because it ended up being an actual pretty unreliable source, we're going to just continue to use the SEC filings and the actual reports. So I pulled them earlier, and they do match the numbers that I had previously for Microsoft, so we know there's nothing weird going on. We were looking at some Yahoo numbers. Their numbers, I don't know, they must calculate their numbers differently. They simply don't log the depreciation and amortization that you find on the SEC reports, so that's what we're going to use. So this is what we used to use. This has become unreliable, so then we can go to, if you just Google AAPL, which is the ticker for Apple, cash flow statement, or I'm sorry, annual report or 10K report, you can see over here filing 10K, then you'll end up on Apple's page right here, investor.apple.com/SEC filing/default, and every page, every company that's publicly traded has something like this. It looks like this on the top, investor relations. I sorted the SEC groupings here by annual filings. So at first it said all filings, I just changed it to annual, and I ended up on this page here, whoops. And then you can just click into it. So I had already have that open, which is over here, and you just scroll down. So when you land on this page, you'll be at the top, and this is what every single one of them looks like. It says United States Securities and Exchange Commission, that's the SEC, Form 10K, and it'll tell you everything you need to know. Obviously, this part here is going to be different depending on the company, and some of them include some different introductory information here, but you just, well, actually, if you use the table of contents, you can probably even use this to get right where you're trying to go. I don't know, that isn't really what I wanted. So what I do is I just use Control F, and I look for depreciation, which, because I was at the end, okay, here. So depreciation and amortization, as you can see, this is the cash flow statement. Consolidated statements of cash flows. Right here, depreciation and amortization. So I'm just going to put these numbers here into my spreadsheet, and I already have that done from earlier today. And then I took a pause because I wanted to show you exactly how I do the rest of this. So now we're going to do accounts receivable. Oops. Let me move this here. Accounts receivable. Oh, that's right here. Sorry. It's already on here. So we have negative numbers. That's what the parentheses mean here. and a positive number. So this, remember, all of these numbers are in millions. So it's not $5,000, it's 5 million, it's $5.3 million. And we're just going to put these numbers exactly as we find them into our spreadsheet. So minus 5322. And now I can actually turn these black. I just wanted to leave them red so some of you kind of had a memory of what had happened before. And then we're going to go and grab the next one, which is minus 2093. And 527. And these are important numbers to have before we do our valuations because they influence the owner earnings right here. As you can see, my formula is, it includes B13 to B17. So these numbers all have to be in here so I can add them in so we can have an accurate owner earnings, which we then multiply by 10, and then we divide by the number of shares. And that gives us a 10 cap price per share. And this is a price that we find reasonable if we plan to hold on to it for at least 10 years. And the saying goes, we don't want to hold on to something for 10 minutes that we wouldn't want to hold on to for 10 years. So now we're going to get into accounts payable, which is right here. 9175. And 8966. And 2117. Now, something that, so these other numbers we have here just because it was on one of the reports we were looking at. The reality is we don't really need to pull these numbers here for all the way back because we don't really care since we can't buy in the past. So these are the prices we think would be reasonable with the numbers they have for that year. So the most recent numbers we have are from November of 2018, and we don't really care about what we could have paid in 2017 or 2016 unless you bought it in, you have that much Apple. What much? This is all of Apple. These are all of the shares of Apple. This is what we're evaluating. No, I don't own any Apple. This is what the valuation would be. So this is what we think is a reasonable amount of money based on those books I mentioned in the beginning of the broadcast, Rule Number 1 by Phil Town and Invested by Danielle Town, which is his daughter. So there's really no point in going and looking at previous reports, but if you wanted to, I'm just going to show you how you would do that. So whose money? This is no one's money. These are just amounts. Okay, so we're going to go look at the reports, and if you wanted to go back, here's what you would do. So if we want to find 2015's numbers, we would just go back to 2015's report right here. You'd click it, it's going to open up the same options that we had on the other one. I like to look at it as a PDF, and it's going to look exactly the same. And you're going to click the same, you're going to go to that same page, cash flow statements, and it's going to give you the numbers not just for 2015 but 2014 and 2013 as well. I'm not going to waste time doing this because it's really not necessary to get these numbers for back any time before this year, really. I just put in the other numbers because it's easy to do because they're all right there, and there is some comparison from year to year, and you can go back and do this as much as you want. I'm actually going to go ahead and delete this because I don't want to actually have that as part of my as in here to think that because I'm going to think, oh, that's the price it should have been in 2015, and that's not actually accurate, but these numbers are. So for our 10 cap valuation pricing is $162. Now we know Apple sells much higher than that, which is $220. But if it were to go to $162, we would find that to be a reasonable price, and we would potentially purchase this stock. If we think it is a good company to own based on all the research we did before this broadcast. This is very much an ending broadcast. You want to make sure it has a good moat, which means it has good protection against competition. You want to make sure it has a good management team that you think is going to carry this business properly, not be too political, and be owner oriented and be humble. You want a company, you want a price that has a good margin of safety, which is what we're looking at now. And what's my fourth M here? So moat, management, margin of safety, and meaning. You have to, this company has to be within your circle of competence. You have to have the capacity to be able to understand this company, and it has to have some kind of meaning to you, or you agree with their meaning, with their mission, with their values, in order to find it to be a worthy investment for you. To be a good investment for you. We don't just look at the numbers. We don't just pull a bunch of companies and punch their numbers in here and buy something that's at the right price, because yeah, we want a company that's on sale, but a company could be on sale because it's not doing so well and it's not going to perform well over time. So for the next two valuations that we have, we're going to have to run some, what's the word I'm looking for here, averages. So I'm going to just go ahead and put myself back on the screen for a moment. Hi. So that I can look up something without showing you guys anything personal of mine. The product videos, yeah. Yep. The new products that they launched, like the iPhone 11. Okay. And actually, let me take this opportunity to say right now, based on the Wilshire GDP ratio, which is also called the Buffett indicator, and the Shiller P/E ratio, the market is currently overpriced, and a downturn or a crash is coming sometime in the future. So this is not something for a short-term gain. These are not stocks that you're going to buy and hope to make money off of it in a year, 2 years, 3 years, maybe even 5 years. These are buy and hold. This is something, again, you're planning on owning these for at least 10 years. Okay, so just keep that in mind as you look at this. Hey, Erin, thank you. It's my birthday today, actually. All right. So this is what I wanted to look at. I'll show you guys what I'm looking at here. These are my notes that I took from the books that I read. So these are the 4 growth rates in order of importance right here. So we want to check the rates over the last 10 years, 5 years, and 3 years. I'm sorry, 9 years, but you pull 10 numbers, 6 numbers, and 4 numbers. Dividends they don't come into play with this. Thank you, Erin. All right, so first we're going to look at the equity growth. Right here, line 6 is equity, and I already have it built into my spreadsheet. Oh wait, we didn't keep pulling numbers from back. Okay, rewind. We have to go pull these numbers. All right, so we're going to go back to 2012, which is going to give us 2012, 2011, and 2010. So let's get rid of some of these newer numbers. We can get rid of this. All right. I don't know what that is, C Brown. So no, I do not. Okay, 2012. Oops, sorry, wait, I'm looking for something before I even opened it. Okay, net isn't going to be a good word here. This is weird. Maybe they don't call it profit. What do they call it? Let's look for revenue. Net sales. Net sales? This looks weird to me. Let me see if there's anything else here. This looks more promising. This is the balance sheet. We can pull some of our numbers off of here. But what I want is I don't know why I didn't search income statement, but whatever, we're here. So this is the cash flow. Here's net income. Do they have growth on here? Or is that only on the income statement? Okay. Redo. No, they don't call it that. That's weird. Every company has its own language. Okay, so here's the cash flows. Income statement's gotta be around here somewhere. Shareholders' equity. On 1,000 shares. So your buying power is obviously much different than ours. Ours meaning me. So Apple right now costs $220. What'd you say, 1,000 shares? So $220,000 of Apple. I'm not looking to invest that much money, but if you are, you do whatever you want. You do you. Balance sheet. Statements of operations. Interesting. Okay. I've never seen them have nothing called an income statement before, but okay. Okay, is that the first thing they have here? So in this situation, going and looking at what either NASDAQ or Yahoo has listed here is actually going to be pretty helpful for me. If you're a pro, then you may not need it, but this is going to help me. Apple income statement 2012. Let's see what we find. Let's check Yahoo here. That is not 2012. Here we go. Macro trends is what I'm comfortable with. I want 2012. Alright, let's go to 2012. Alright, 2012. So they have 156,508. Okay. Alright, so that is what they call net sales. That's actually their gross revenue. Let's make sure we agree with that. And then net income they have down here. Okay. Okay. 156,508. Is this in millions? Yes. Why does that? Oh, I'm putting that in net. Okay, my bad. Oops. I need those millions. There we have it. and then net profit, and I'm going to compare the two. 41,733. Net income. Yep, that matches. That's good. Oh, it's my last chance. I'm so worried that I'm never going to get a chance to learn about this ever again. Okay. Bollinger Bands. Technical analysis tool. Specifically, they're a type of trading band. Trading bands and envelopes serve the same purpose. They provide relative definitions of high and low that can be used to create rigorous trading approaches and pattern recognition for much more. I'm not trading. I'm buying and holding. Okay. So equity. Why do I keep clicking that? Same thing. Oh, how? What do you? Okay, so Bollinger Bands at Apple. Really don't have time to be taken off. Bollinger? They're saying Bollinger. Oh, I'm so enlightened. I don't know what I'm looking at, dude. And I don't have time to sit here and learn something from scratch. I'm trying to just show you guys how I do my valuation method, okay? So if you want to teach me, you can, but you'll have to like message me and enlighten me when I'm on a pretty big deadline right now. So I appreciate that you're trying to teach me something. This looks like it could be interesting, but I really don't have time to like, it's not like something I could just look at and be like, oh, very interesting. Like, I don't know what I'm looking at. Okay. So where are we? Total shareholders equity, 118,210. Hey Shara. Alright, why am I not pulling these other numbers? Sorry, I'm getting a little distracted. I've been a bit stressed out today, so it's not his fault. You don't have time, LOL, you on scope. Wow, you are a genius, aren't you? Alright, so the next one is 76615. Just so you know, this is my full-time job as a live streamer, so this isn't like free time to do this. Okay. This is interesting, like why do they only have 2 years down below but then 3 years here? Whatever. I'm gonna stop asking questions and just put the numbers in. 108,249. $65225. Yeah, and I'm not trying to learn how to do day trading. As someone with a different job, I'm not investing full time, so I'm doing a strategy that doesn't require me to check on charts every single day. Okay, so then we have 25922. Ooh, that's a 60% increase. That's a beautiful number. And 14013. It's not day trading. Okay, what kind of trading is it then? What is being a trader? I don't know what that means. Okay, operating cash. Okay, good night, Cher. I love you, girl. 5856. 37529. And 18595. It's so cool to see how much change has happened over the last 8 years, 9 years. 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, I need one more year here. It's weird that the equity, like, am I high, or does equity only have 2 years on it? See? They have 2012 and 2011, but where's 2010? Like, why are you not on here? Whatever. Alright, so we need to go back. Let's go to, we're going to need to pull the 2010 since we're missing one of the numbers. Oh, wait. I didn't pull this number either. Equity plus debt, which is 176064. Oh. And 116371. Alright, let's go to 2010. So that's it for that. Something weird about this page with Apple, I always have to refresh it and then click annual filings again, because otherwise it just defaults back to all filings, even if you click annual filings. Thank you, Jamie, for the super hearts. Birthday hearts. Our goal on this broadcast is 23,000 super hearts. Excuse me. All right. And you can see how I move through here a lot quicker than I did when I first saw it, because it looks different than Twitter, it looks different than Microsoft, it looks different than First National Bank. So it just takes me, or sorry, First Republic Bank. So it just takes me a little while to get my bearings with the different reports. But every company has a little bit different style, but once you get it, you can move much more quickly through it. So we're going to make sure this matches. 65225, it does. And then we're going to put the other numbers. 42905. And 37491. And we're going to pull our net numbers, which are 14013. Yep, that matches. Oh, and 8235. Thanks, C. Brown. Good luck with your securities trading. 6119. Bye. Equity, operating cash. Okay. 47791. Let's make sure that matches. Oh, we didn't have that number. Okay. 47791. $31640. Equity plus debt. 75183. And 47501. Alright. Now our operating cash is the only number we need to go, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, that's perfect. Perfecto. And then we can finish our valuation. The other two prices. We already did one price, but we got to do the other two. So we have operating cash. We'll go to cash flow statements. And cash generated by operating activities. That's this line right here. Sorry, I'm kind of flying through it at this point, guys. I know some of you are trying to learn. There you go. That's the line I'm looking at. 18595. Yep, that matches. And then we have 10159. And 9596. Alright. That is beautiful. Now we can find our average. So what we want to find is the average change right here, 51%, 60%, 54%. I'm going to add all these up, and I'm going to divide them by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. No, 9. Divide them by 9. Okay. So I know you can't see my calculator right now, but that's what I'm doing. 51.05 plus 60.31 plus 54.29 plus 4.52 plus, minus 9.71 plus 7 plus 7.45 plus 4.52 minus 20.07. We're going to divide that by 9 and we get 17.71%. That is a good number. We like that number a lot. I'm going to go ahead and pull up my, let me just hide this real quick. I'm going to go pull up my little Apple cheat sheet. Where I put my notes. Apple. I'm wondering actually if I did this with Microsoft, if I can just kind of copy what I did there. Ooh, yes, that's beautiful. Let me show you. Let me show you. I'm all proud of it. So this was, so these were my numbers that I ran for Microsoft. So what I'm going to do is I'm just going to copy this. For Apple. I showed you. Alright, now open up Apple. Nine, 17, 19. Paste. Itch my nose. Then put it in the sheet. No, these are, no. No sheets. Hang on, let me show you. So, let me show you. Okay, so I'm going to take the numbers that I'm getting from my sheet. I no longer need to have Microsoft open at this point. I really don't need any of this open. And I'm going to take my average, which I got from this row here, row 7. I'll just go like this. And I got that average, and then I'm putting it into my doc here, which was, what did I say, 17.71. That's good. That meets the number that we want it to be. Then we're gonna, actually while we're there, let's just do the rest of them for equity. That might be the easiest way to do this. So let's do 2013 to 2018. So we're gonna start right here. 4.52 minus 9.71 plus 7 plus 7.45 plus 4.52 minus 20.07. That's not going to be a good number. It's already a negative number. Divided by 1, 2, 3, 4, 5, 6. That's not actually, I wasn't supposed to use 4.52. I was supposed to start here. That's even worse. Okay, divided by 1. Okay, clear. Okay, minus 9.71 plus 7 plus 7.45 plus 4.52 minus 20.07 divided by 5 then, right? 1, 2, 3, 4, 5. And we end up with negative 2.16. That's terrible. That's really bad. Really bad. Alright, minus 2.16, so we're going to put that there. And then we're going to do the last 3 years, which is probably going to be even worse, because that minus 20% is terrible. Alright, so we have, this is supposed to be what, 2015 to 2018, right? So you have these 3 numbers. 7.45 plus 4.52 minus 20.07 divided by 3. And, oh, it's actually the same number. That's actually a little worse, minus 2.7. Not much worse though, about the same. All right, then we're going to go to earnings per share. So these are in order: equity, earnings per share, net profit, and cash flow, in order of importance. So equity is the most important number we're looking at. We want that number to be 10% or higher. The fact that it's negative makes it not something that we want to buy, but again, we might have our hand forced by having to buy it as part of a fund if we're investing in a fund like a S&P 500 or an ETF or mutual fund, whatever it is. Okay, so we have earnings per share. Okay, so we're going to go back pretty much as far as we can here. And this is our line that we're looking at, line 23 here. So we're going to start with this number. So 35 plus 70 plus 85 plus 61. Minus 11 plus 7 plus 35 minus 14 plus 6 plus 23. We're going to divide that by, what did I say before? 9? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10. Divide by 10. That gives us 29.7. That's a very good number. Very good. But again, those old numbers are even better. So the older, that's why we check the more recent numbers as well. Now, I just want to make sure I'm doing the right numbers here. So this is actually from 2008. So I'm going to adjust my number just a smidge. Actually, I shouldn't. I really shouldn't. I should probably edit what I'm doing instead, because I'm starting before I need to start, which means I should actually be starting here. Phooey. Well, actually, if I take my number, multiply it by 10, and then minus 35 from it, and then divided by 9, there we go, 29.11. But I'm gonna do the equity again on that one, just to be consistent. Oh no, that was consistent because we didn't have a number for 2008 on the equity, so that's actually fine. Okay, so equity is good. All right, good. So we can go on. So now we want to check earnings per share from 2013. And we're going to start here. So we're starting with the 7%. 7 plus 35 minus 14 plus 6 plus 23. Those are still some pretty good numbers, I'd say. 1, 2, 3, 4, 5. Divided by 5, we have 11.4. Hey, Midnight. I was talking about drip investing before this, actually. 11.4. That's still good enough. As long as it's over 10%, we are happy. Happy little investors. And then, oh wait, what am I doing? Yeah, earnings per share from 2015. So then we just have these three numbers here. So we have, clear, minus 14, plus 6, plus 23, enter, divided by 3, gives us 5. 5 is not as high as we want it. Thank you, Midnight, for the super hearts. Birthday super hearts. 5%. That's not a good number. So actually, you know what we should do? This would be an interesting. I should actually turn red anything that's under 10. It'll be easier to look at. I'm going to go do that with my Microsoft right now, too. So according to these numbers, this really isn't a great buy. I know people are so gung-ho on these stocks, but I guess Microsoft's not too bad right now in its growth. Equity is the only thing down, but it's only increasing by 1%, and that's the most important number that we look at, so just something to be aware of. All right, so now we're going to go into net profit. We can get rid of that. All right, so net profit. Thanks, Midnight. net profits. So we're going to start here. Oh, went too far. There we go. 70.16 plus, I can't actually see, my calculator's on top of it, 84.99 plus 60.99 minus 11.25 plus 6.68 plus 35.14 minus 14.43 plus 5.83 plus 23.12 divided by 10, 26.12. That's a good number. And then net profit from 2013, 6.68 plus 35.14 minus 14.43 plus 5.83 plus 23.12 divided by 5. We have 11.27. $265 billion, yes it is. Okay, so that's still good. And then net profit from 2015, we have minus 14.43 plus 5.83 plus 23.12 divided by 3, 4.84. Not good, not good. So Apple's actually having a down couple of years. Now their version of down and our version of down is probably two different things, but this is actually like, this could potentially put it on sale, you know, because these numbers aren't great. So we'll still keep an eye on it, but alright, so cash flow. Cash flow, cash flow, cash flow, which is right here. We're gonna go to this number here. 83.04 plus 101.82 plus 35.51 plus 5.53 11.27 36.09 minus 18.5 minus 3.03. See how the numbers are going negative now as we get closer to the present day? And then it jumps up 20%, not too bad. Plus 20.57 divided by 10. That gives us 27.23. That's a good number, but it's more based on old numbers. Isn't Microsoft worth more than Apple then? I mean, on the pricing that we've done so far, I'm pretty sure Apple got a higher valuation. So, yeah, $86 versus $162. So we're actually pricing Apple higher. Now, what are we looking at? Operating cash. Okay. Now we're going from 2013, right? Is that right? 2013. Yeah. Cash flow. So that gives us 11.27 plus 36.09 minus 18.5 minus 3.03 plus 20.57 divided by 5 gives us 9.28. That's not quite high enough. Very similar to Microsoft's number, interestingly. Of course, boxing, my pleasure. Yeah, a lot higher, yep, exactly. And then we have minus 18.5 plus, oh, just not plus actually, minus 3.03 plus 20.57 divided by 3 is minus 0.32. So that's actually going down on average. Not great, not great. But if you look at Microsoft's version of this, you can see that Microsoft has the same thing going on. Actually, no, it doesn't. Sorry, theirs are a bit different. I'm sorry, I thought it was the same. So they, from 2013 to the present day, they were all below the number we want it to be. Hey Naomi, it's me, yeah. And then Apple is today. Hi. Trying to be a little bit quiet because the kids are asleep. Also trying to fly through this. So now we pick our estimated growth rate. Okay, so we got everything that we need on here. We're going to go to our payback time. This is old numbers. These are numbers from Microsoft. So we need to put in our Apple numbers, 4601. Actually, let me just copy this number, paste it, copy it, make sure I didn't add anything. Okay, so that's the number of shares. Now the estimated growth rate. We have to decide this. So the free cash flow. So this is based on owner earnings. I'm sorry, not owner earnings. This is based on free cash flow. It is based on owner earnings. I'm sorry. What am I high? Free cash flow. Wait, what? Why does it say B17? That does not seem right. Plus C17. Maintenance capital expenditures? That doesn't seem right at all. Operating cash plus maintenance capital expenditures. I'm not sure if I'm even going to have this written down. Let me go look at my... I'm trying to think if I added in a row or something, if that messed with this. This has that too. Is that really right? Let's look at Twitter. Yeah. Okay, we're just going to go with it. We're just going to assume that that's right. It's been a little while since I reviewed why it's doing this. I mean, why the numbers do what they do. I just kind of accept it. Okay, so we have 64121. That's what we're going to plug in here, our free cash flow. And now, don't worry about these numbers yet, because we have to come up with an estimated growth rate. So how much do we think the free cash flow is going to grow over time? Luckily, we have enough numbers to look at this, so why don't we look at these numbers down here. So we have, let's just look at them historically. 6 plus 83 plus 102 plus 36 plus 6 plus 11 plus 17. Minus 24 minus 3 plus 24 divided by, I think that's 11 numbers. 3, 4, 5, 6, 7, 8, 9, 10, 11. Nope, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10. So on average, it's been 25.8%. Historically, let's go from 2013. We have 11 plus 17 minus 24 minus 3 plus 24 divided by 5. That gives us 5. So it's averaging 5% increase. Here, did I do those numbers right? 11 plus 17 minus 24 minus 3 plus 24 divided by 5. 1, 2, 3, 4, 5. Yeah, 5. Whew, 5% is not very much. Okay. And then in just the last 3 years, we don't even want to think about that. That is minus 24 minus 3 plus 24. Really, it's just minus 3 divided by 3, which gives us minus 1. So I know everyone's going to hate this, but I'm going to give it a 5% estimated growth rate. Because I like to be really conservative with my numbers. So that means that if we want to make a decent return on our investment by 2026, then we are going to be willing to pay $140 for it. So you can see there's not a big discrepancy here, 162, 140. These are just different methods of valuating a stock. So you're going to come up with different prices, but hopefully they'll be in about the same price range. When we did Microsoft, the margin of safety price, which we'll do next, ended up being significantly lower than the others, so we kind of just throw that away. So we're thinking 162 is like the most we're going to pay for it. 140, even better. Margin of safety price. And this is all going to depend because their free cash flow might be pretty good compared to their owner earnings. So the 10 cap pricing is the price that's based on owner earnings. Owner earnings is a number that Warren Buffett invented. Hey Tyler, it's only 17 minutes left on my birthday. Oh my god, what am I going to do? Okay, it's fine. Margin of safety price. Now again, these are Microsoft numbers. So we are going to delete. Good. And we're going to change that. See, I had a 5% estimated growth rate on this for Microsoft because their earnings per share was getting pretty crappy. Alright, so we're going to go back here. We're going to look at the earnings per share. And we're going to check out their numbers historically. So we're going to grab 35 plus 70 plus 85 plus 61 minus 11 plus 7 plus 35 minus 14 plus 6 plus 23. Divide that by, I think, 10, but let's make sure. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oop. Divide by 10, that gives us 29.7. That's a pretty good number. Then we're going to take it from 2013. So we're going to take 7 plus 35 minus 14 plus 6 plus 23. We're going to divide that by 5. 11.4, okay, that's still pretty good. And then we're going to do this number here, which is not going to be great, but it is what it is. Minus 14 plus 6 plus 23 divided by 3 gives us 5. I'm going to go ahead and actually give that a 10% estimated growth rate. And, oh, I didn't put the earnings per share in, which is right now $12.94 per share. That's actually pretty good. But again, our margin of safety price, oh wait, estimated PDE. Oh wait, I gotta go check this. Hang on. This is something I have to pull up my little note on. Margin of safety price. Lesser of 2 times the estimated growth rate or average historical PDE in the last 10 years. So now we need to go look up Apple historical PDE. Thanks for inviting, Lou. This is a pretty good, this is from 2006, so this is good. This is the number we want. And what was it? We're looking for the lower or average in the last 10 years. Oh yeah, I had to average this out by myself manually last time. Okay, so to go back 10 years, we're going to, this is the PDE down here. 10 years ago puts us at 2009. So 2009, except we're going to go with the date that they do their, that number's good, that's fine. Well, this is 930, I actually kind of like that better, because what's this number here? 917? Yeah, that's fine, let's go from 930 to 917. Is it the same? 21.7? No, okay, sorry. 21.7 plus, and then remember, we're not going to do it by month, we're going to go back to, we're going to go to September 30th of 2010, which is here. 16.47 plus 12.12 plus 13.34 plus 10.88 plus 14.48 plus, woo, noisy neighbor car. 11.24 plus, hang on, I gotta move my calculator here. Wait, I just want to make sure. I already did that number, right? Yeah. 13.13 plus freaking Lou. I love you so much. I can't even. You know it's my birthday for the next 13 minutes, Lou? 16.38 plus, we're getting there, 18.87 plus, we'll put what it's at today. It's close enough. 18.82 divided by, so that gave me what? What did I go back to? 2009? That was 11 years. Which gives us 15.22, and we're picking what, the lower of the two? Okay, so this is actually the average PDE is actually the lower of the two, which is 15.22. So here, let me show you. That's not how I show you. Okay, so this number is either going to be twice of my estimated growth rate, which is 10%, so it would either be 20, or the average historical PDE, which is 15.22, whichever is lower. And because 15.22 is lower, we're going to go ahead and put that in instead. It's still such a low price. I feel like, why is it always so low? Oh, because I didn't copy this down. Still low. Still very, very low. I don't know. I guess it just is what it is. Twitter wasn't like that. Twitter wasn't a big difference, but this one is $70. Obviously, we're not going to get Apple at $70. Yeah, I know. You know, I don't take any days off. I'm also going to be in Florida for like this whole rest of the week, so I really should be asleep right now. Okay, I have to go do the monthly sponsor thing. So those are our 3 pricings. I'm so proud of us that we got the valuations done. Our 10 cap valuation is $162. Our payback time pricing is $140, and our margin of safety valuation is $70.24. So the most we're going to pay is $162. To get it for half the price than we think it's worth, it would be $70.24. So again, it's really not that much different. A reasonable price we still have here is $140, but our margin of safety, so that we're buying things when we want to get $1 worth of value for 50 cents, that would be $70.24. So I hope that you guys enjoyed this. I know I really flew through a lot of that. This is the 5th one, I think. Let's see, we did Twitter, Microsoft, First Republic Bank, and now Apple. So this is the 4th one we've done together. Some of you have been doing it with me over the last year. It's probably getting a little bit easier to comprehend for some of you. Some of you, this is brand new and you're like, that was way too fast. Totally fine. Just comment below or message me. You can direct message me on Instagram or Twitter, or email me nextjuice@gmail.com. We can discuss it further, and I'm going to continue to do this. I'm going to continue to study companies. I actually don't know who my next company up is. Let me check. I don't have it too easily here. Okay, fine. Let me look it up real quick. Real quick. Our next one will be Amazon. Our next company up is Amazon. Amazon, which is currently trading at $1,822 a share. And the ticker is AMZN. So that'll be the next company that we research and do a pricing analysis on, and I hope that you guys will be here with us. Please subscribe on YouTube. Oh, YouTube commenters. Oh, I totally have been neglecting you. I'm so sorry. I'm sorry. Yeah, I know I'm in black and white, and I totally missed so many of these comments. Nope, it's all black and white. I'm not using a Snapchat filter. It's just a really, really crappy webcam, so if I make it black and white, it looks a little less crappy. Thank you, Maps. GamerB, hi. Okay, good night, Shara. I love you guys. Yeah, I just read it now. Sorry, guys. I totally was in the zone and forgot that I was live on YouTube and should probably read those comments too. I love you guys. This has been A Moment in Time with Taylor. Please do click the link in the profile, nextjuice.com/support. Help me to keep this channel going and growing together. Let me know what kind of content you want to see. I do cater my content to my sponsors. All you guys here make this whole thing possible. I can't say thank you enough. Thank you for supporting this channel over the last 30 days. And remember, we're going to have a special event right now that's only open to monthly supporters of the channel. You can learn more at the link, nextjuice.com/support. And I'll see you guys in just a minute. I might be a couple minutes later than I planned to be, but I'm going to do this as fast as I can. And I'll see you on the next juice. This has been A Moment in Time with Taylor. See you later. On the next juice. Bye.